The Indian government has recently introduced significant tax reforms aimed at reshaping the country's economic framework. These reforms have generated mixed reactions across different economic groups, particularly affecting the poor, middle class, and wealthy individuals. This document provides a comprehensive overview of the new laws, their implications, and their potential long-term impact. Key features of the new tax laws. Capital gains tax revisions. The tax rate on short-term capital gains, STCG, has been increased from 15% to 20%, affecting investors who sell equities held for less than a year. Long-term capital gains, LHSAG tax on equities, has risen from 10% to 12.5%. Real estate transactions have seen reduced indexation benefits, with LTCG now taxed at 12.5% without inflation adjustment for properties bought after the reforms. Securities Transaction Tax, STT, increase. STT on futures has been raised to 0.02% and on options to 0.1%. Impacting traders and market participants. Income tax modifications. To support the middle class, income tax rates for individuals earning up to Rs 1.5 million annually are proposed to be lower. High-income earners benefit from a reduced surcharge, with the top rate dropping from 37% to 25%. Impact on different economic groups. Poor and lower middle class. Increased taxes on investments may indirectly impact small savers and investors by lowering returns. Rising inflation coupled with tax hikes may further strain household budgets, reducing disposable income. Middle class. Reduced income tax rates provide some relief, but increased taxes on equities and real estate could slow wealth accumulation. Higher transaction taxes may discourage participation in financial markets, impacting long-term financial planning. Wealthy individuals. Wealthier segments benefit from reduced surcharges and often leverage advanced tax planning strategies to minimize the impact of reforms. The new rules may promote long-term investments, favoring individuals with substantial financial resources. Economic and market implications. Market sentiment. Short-term volatility in stock markets due to higher taxes on equities and derivatives. Consumption patterns. Proposed income tax reductions may stimulate consumption among the middle class, potentially boosting economic growth. Investment behavior. Higher taxes on short-term gains may encourage long-term investments, stabilizing the markets. Conclusion. The recent tax reforms in India aim to enhance revenue generation while promoting economic stability. However, their effects on different economic groups are varied. While the middle class and poor may experience higher financial pressures, wealthier individuals stand to benefit from structural adjustments. The long-term impact will depend on effective implementation and periodic policy evaluations to balance growth and equity.